Hi, welcome to the investment update with Generate. I'm Stephanie, one of the Generate advisors here, and I'm here with Ayrton Olivier, our portfolio manager.
Morning.
Morning, welcome. So volatility has returned to the market. What's been driving this?
Yeah, so when Trump got re-elected last year, it was to be expected that volatility would come back into the market. He has a lot of views on global policies and geopolitical issues, especially trade policies. And so now that he's in, he started to enact some of these. So those include a 25% tariff on Mexican goods, on Canadian goods, and an additional 10% tariff on Chinese goods, and also looking to pull defense support from Ukraine. So all of these kind of things are causing a bit of worry around the world. The main worry is also coming from retaliatory trade policies that are coming across. So China is looking at putting tariffs on US goods. Canada is looking at putting retaliatory tariffs on US goods also, which could fall into a full-blown trade war, which will slow down global growth, hurt US companies, hurt global companies, and really just slow down global trade. On the defense side, Germany stepped up and is now looking to spend up to 500 billion euros to bolster German and European defense spending, which will help Ukraine. It did cause some very large moves in German government bonds overnight. So although it was only 0.3%, which doesn't seem like a big move on their borrowing costs because of the extra spending, for Germany, they have a special rule to borrow more money. They have to get it past Parliament, and 2/3 have to agree, and it's something they don't do very often. So it was a bit of a shock, and it was the largest move in their government bond yields since 1997. And on the trade front, I guess the volatility is coming because it changes so quickly. Trump will come out with a tariff, the other country will come out with another tariff, and then Trump will say, oh no, we've come to an agreement, and then those tariffs will either not be enacted straight away, or there'll be a month, or it will be only on certain goods, or it won't happen at all. So it's causing a lot of volatility in stocks and giving uncertainty to the market, which I guess the market doesn't like.
No.
So other economic data has been slowing in the US. So previous to this, the US economy had looked pretty strong. The consumer was going along pretty well, and the Federal Reserve decided to hold rates steady last month. However, since then, we've got a slowdown in consumer confidence, retail sales, and it's looking like American growth actually could be slowing. So it does now look like the Federal Reserve may be able to cut again, not because inflation's coming down. Inflation has kind of stalled. It's not going down as fast as hoped, but the Federal Reserve may need to cut because global growth is slowing and US growth is slowing.
So what does this mean for stocks and bonds? Should we be worried? What are we doing?
Yeah. I guess volatility is part of normal investing. It's a normal part of the market. It's nothing to really worried about. It does give rise to opportunities. So as an active manager, we can take advantage of moves in the stock market and the bond market as we see fit, and if we think there is opportunities popping up. For instance, just overnight, on the back of the Ukraine issue with Trump, so Trump pulling military aid from Ukraine, Germany has now stepped up and said that they may spend up to 500 billion euros to bolster defense spending in Ukraine. That's caused a huge move in German government bonds. It was the largest move since 1997 overnight, and it's bolstered European stocks. So what was previously a US-driven kind of stock market move is now moving to Europe, as there's more money being spent in Europe, and Europe looks like to be the place to, ramp up spending to bolster their defense budget. So it is giving us opportunities across the world. Volatility will remain, but I don't think it's anything to be too worried about. On the bonds front, the slowing in global growth probably means that bonds might come back into favor. You're seeing Federal Reserve potentially cutting rates again. People usually flock to bonds when stocks are looking a bit more volatile. So lower rates mean bonds prices go up. And so we might see a bit more action there.
Yeah. So closer to home, the RBNZ cut the rates again last month. What does this mean for mortgages?
Yeah, so thankfully, means mortgage rates coming down. So the RBNZ cut rates 50 basis points as widely expected. I guess the main thing to point out here is that the swap market, or the wholesale interest rate market, is already expecting these cuts. And so there was not any large moves in the wholesale interest rate market after the RBNZ's cut. The one thing they did mention in their meeting was that they think they can cut rates a little bit faster than previously thought. So they now expect another 3 cuts this year, so bringing the cash rate down to 3%. Although the interest rate market already expects it, it does mean that, that we could hopefully expect that term rates, like the 1 and the 2 year mortgage rates for borrowers, will slowly start coming down. The next thing now is for banks to start being competitive and reduce their margins so that we can actually pass on those rate cuts. But hopefully that will start spurring a bit of a recovery in the New Zealand economy, which is very badly needed.
Yeah. So what are the key events to watch out for from here?
Well, Trump tweets, really. It's just unpredictable. He will come out and say, we're going to slap tariffs on you. And then in that same afternoon, he'll say, maybe next month. Or he'll say, we'll walk it back if you come to the table and meet us. And that seems to be his negotiation tactic. He'll come out there with the worst case scenario, hope that you, as the other country, will come to the table with something, or meet him halfway. So I guess just watching what his global policies, how they evolve, and how the defence spending in Ukraine and Russia, if it comes to some kind of peace deal, or if the US completely withdraws from defence support for Ukraine or not, will be key for geopolitical risk. And then for us closer home, we've got GDP later this month, so that will give us a good steer on whether or not the cuts that we saw last year have started to spur on the economy or not.
So watch and wait. Thanks for sharing the insights, Ayrton.
Very welcome.
Thanks for watching.